A new real-world asset class is making 15 to 20% annual returns. No, it's not crypto, and it's not through stocks. We've been seeing a lot of recent data come through about energy rates impacting market dynamics. We're talking about electricity. While you were sleeping last night, thousands of batteries across California charged themselves with dirt-cheap midnight electricity, then sold it back to the grid during tonight's evening rush at prices 10 times higher. This is pure arbitrage, and it's creating a market worth potentially $167 billion by 2030. This is part 1 of breaking down the energy revolution. Part 1, the arbitrage opportunity. Here's what most people don't understand. Electricity is the most volatile commodity on Earth. Oil might swing 5 to 10% in a day during a crisis. Bitcoin swings 20%, but electricity rates can experience multiple 1,000% price swings within 24 hours in deregulated markets. Why? Because electricity is working against physics, not just pure economics. It must be consumed the exact millisecond it's produced. You can't warehouse it like corn or gold. At least you couldn't until battery costs dropped 90% in 14 years. Now we have a solution. You buy your energy at noon, and then sell at 6 p.m. Rinse and repeat, 365 days a year. Section 1, the 4 tiers of energy banking. The energy banking market has 4 distinct tiers, each with different risk-return profiles. Tier 1, residential arbitrage. Batteries like the Tesla Powerwall can help homeowners optimize the exact rates of usage and arbitrage the high-value usage periods. Tesla owners in California report recovering 12 to 18% of their investment annually through pure arbitrage. When this is connected to solar generation, that jumps to 20 to 25% in avoided grid purchases over the lifetime of the project. Tier 2, community energy banking. Pooled neighborhood batteries achieve better returns through shared infrastructure. This is similar to organizations like credit unions, but instead they are pooling electricity. Essentially, entire communities can realize their cost savings through this model. Spain's renewable energy cooperatives have grown 900% since 2018, with members receiving dividends from both energy generation and arbitrage trading. Tier 3, commercial behind the meter. Factories, storefronts, restaurants, and office buildings can do what traders call double dipping, essentially cutting demand charges, which can be 70% of commercial electricity bills, while simultaneously arbitraging energy markets. The payback period for these batteries are half that of residential systems. Tier 4, decentralized networks. Now we're talking about more complex situations, virtual power plants coordinating hundreds of batteries for sophisticated grid services. These large-scale projects usually require a significant amount of upfront capital, but once they're up and running, the returns can be in the millions. Here's a real example. Australia's Hornsdale Power Reserve, Tesla's big battery, earned $29 million in 2023 from frequency control services alone. These initiatives have a vision of continuing to democratize energy access across entire industries as more energy rates become volatile. Section 2, why returns keep growing. There's a paradox for this type of system that makes this opportunity unique. As more energy players enter the market, won't returns compress? Actually, no. More renewable energy on the grid means more volatility, not less. Every new solar farm makes sunny days cheaper and cloudy evenings more expensive. The arbitrage opportunity grows with the energy revolution. It's a self-reinforcing cycle. More renewables means more volatility. More volatility means better arbitrage returns. Better returns means more capital into storage. More storage enables more renewables. And the loop continues. The early winners are already clear. California has predictable time of use rates and high solar penetration. Australia has the highest renewable percentage in the developed world. Germany has a strong feed-in tariffs and grid services markets. Spain is experiencing 900% growth in community energy cooperatives since 2018. Section 3, the real question. So who is positioned to benefit from this new energy revolution? It's not the battery manufacturers. They're getting commoditized fast. Prices are dropping 10 to 15% annually as new technology continues to lower costs. The installers, these networks are fragmented, focused locally, and have a low margin. The sophisticated algorithms that can trade simultaneously across multiple markets require a comprehensive intelligence layer. They need real-time data and forecasting. They need infrastructure to verify, settle, and monetize rates throughout the day. This layer is the solution. The intelligence to optimize for the greatest cost savings and value returns to the grid is the opportunity. If we can accomplish this and scale it, we can help to accelerate the energy revolution and return the power back to the people who consume it literally. In part 2, we'll break down the algorithmic edge, how AI is turning battery banks into trading desks, and why data centers are becoming the biggest players in this space. The energy revolution is happening now. In the next 2 videos, we're going deep on the technology and infrastructure that's making it possible.